Okay, good day, good morning, good afternoon. How are you, student? I hope you are doing well. So today I want us to check a topic in Form 4, that is topic 2, and that is entitled financial statement. So in this topic we are going to try to determine how the business how the loss or profit in the business can be calculated using 3 different accounts. And the first account is trading account, the second account is known as profit and loss account, and the third account which will be a repetition. Remember previously in Form 3 we talked about balance sheet. Balance sheet is also something or another account that we are going to talk about here. But now in Form 4, the balance sheet in Form 4 is going to be a little bit detailed because there are some additional information that are going to be added. Remember, when you are talking about maybe prepaid insurance, in previous Form 3 work, we didn't talk about something like that. But prepaid premium or prepaid maybe rent, those are assets. Those are money that belongs, they are like the money that belongs to you. If you pay something in advance, that is supposed to be an asset. So we'll talk about that. There are some additional information that are going to be added in the balance sheet. But then, the context is very important, or the objective. We must have the objective before we start. But then, before you do that, please, it's always a custom, it's always a procedure that wherever you are in to attend a class, you get into the WhatsApp, you log in. After that, you write your name into the link that are going to be provided there. Then after that, you write your admission number, then you submit so that I'm able to know how many people or how many people attended the class. Then after that, after going through this, there is also an assignment that I'm going to send in the same forum, that is WhatsApp. Just get into the link, then do the assignment, then submit. Don't just do it, then leave it. You ensure that you submit. So welcome, and I welcome you back again. So the context we are going to talk, we're going to look at the introduction. First of all, statement of account. This introduction that we ought to understand. Then the concept of trading period. Then when you say trading period, what does it mean? When you say trade period, we are going to look at that. Then determining the profit and loss. Then after that, you're going also to look at the balance sheets, which will be later. Then basic financial ratios, like markup, margin, and etc. I think I kind of gave you a clue on them, but then here we are going to look at them. We are going to know how to calculate them based on the ratios, based on the percentage, and even the fraction. But then if you look at our class, we are going to do some kind of introduction, then later we are going to look at the concept, then we are going later to determine the profit and loss. So first of all, when you say business, in Form 1, we talked about business as a discipline. We talked about business as a subject that is always being studied. But then, the business activity itself always has got a main aim. And that main aim is always to make profit. I hope up to where we are, we understand the objective of a business in society. The main one is always to make profit. Just to make us remember, or just to do some recaps, in the business, especially Form 1, we have got importance of studying business as a subject. Then we also have the importance of a business activity in the society. So one of the main objective, or one of the main importance, is to make profit, among others, like provision or providing employment, you understand? And also maximizing the utilization of resources around, and etc. So those are there are always two areas where exams can come, or two areas that a question can be asked. So don't get mixed up. So in making profit, sometimes actually the business may not make profits. Sometimes the main aim is of profit, but sometimes we may end up getting a loss. So there is a way that can be determined. So to determine the amount of profit or loss that is made, proper accounting records ought to be prepared. You have to prepare some trading or accounting record. And these accounting records enable us to know the financial position of the business. And such accounting records, we always give them a termination, or we always give them we always give them a definition, that is financial statement, and that is our topic. So financial statements, we have what's types. We have 3 types, especially that we're going to talk about in Form 4 here. We have trading account, we have profit and loss account, and we have a balance sheet. The major area we're going to concentrate is how to prepare them, then after that, their purpose. But how to prepare them is very, very much important, and that is very much examinable. So after that, we are going to look at what is known as the concept of accounting period. When you say accounting period, what do you mean by accounting period? So accounting period, the trading period refers to the period of time that elapses before a business calculates its profit or losses and determine its financial position. You can see that. Then these periods can be 1 month, 2 months, etc. Or normally this period is 1 year for most of the businesses. When you say that, maybe somebody is calculating, for example, let's say that you always calculate the profit or the profit of the business, and that duration that elapses that a business calculates their profit, maybe it could be maybe September of every year. Some people may do it after 1 month, or some people may do it after 2 months, or some people may do it yearly. Like the government, they always do it yearly. So that is what is known as accounting period. That's duration that you always categorize, or you have always set to do calculations based on the financial position, to calculate the financial position of the business. So that is what is known as accounting period. Let's say in a yearly, maybe we say that December, a date maybe 31st, you are doing calculation December of each and every year. So that means that you are dealing with an yearly calculation of the profit, or determining profit that is there. Or sometimes it may not be profit, but it's a loss. But if there's a loss, then let's know that there are a lot of problems maybe in the business that business is supposed to change from. So at the end of the trading period, therefore, the following will take place. What do they do at the end of the accounting period? One thing that they always do, all the ledgers accounts are always balanced. We talked about the ledgers. So preparing the ledgers, we know. But then at the accounting period, at the end of a trading period, which is also known as accounting period, one thing they always do is that they balance all those ledgers. For example, let's say that if you are having cash, if you are having cash, let's say that cash account, for example, DRCR. Let's say that here we are having capital. Let's say we are having 100,000. Then there was use, that's the cash in hand was used maybe to purchase some items, maybe furnitures in the business and etc. Let's say there may be furniture, or purchase 10,000, for example. Then maybe salary, some workers were paid their salary and in cash, so salaries. So let's say, for example, just trying to do a recap on whatever we have done so that you see. So doing this is opening a ledger account. But then at at the end of the accounting period, the trading period, we always do what is known as balancing. And you know, we can remind ourselves, rebalancing of the balancing of the ledgers account. What we simply do is that we compare the DR, or the credit side, debit side, and the credit side. And we always know that if the debit side is higher than credit side, what we always do, we get the differences. You understand? So if we get the differences, that is going to help us to find what is known as balance carried down, to get the amount that is remaining for the another side to balance with the higher side. So here, because we don't have a lot, here because we have the biggest figure, or the biggest balancing figure, we are going to balance it straight away. Then here we're going to add 10 plus 5,000, that is 15,000. 15,000, if you subtract from here, it's going to be 185. So balanced balance, or we say balance carried down. Balance carried down is equal to 185,000. So 185,000 will be the balance carried down. So if you add all of it, it's going to be 200,000. Then here you bring balance brought down, the money that the business closed it with, which is the balance carried down in the credit side. So I hope you understand it. So this balancing always happen at the end of a trading period or accounting period. So that is one of the things that always happen there. This is just an example to make us remember. That's why I've done that. So that's all about ledger, but we are in the financial statement. Then trial balance, also trial balance, we know that it's always account that is always used to check whether the ledger's accounts are correct. And I know you know what trial balance are. So after that, we are what's always happen at the end of a trading period is that the profit and losses are determined, and also balance sheet is prepared. That's always what's happened. Then the next thing is determining the profit or loss. How do we determine the profit or loss? So the business buys or produces the goods and services they sell, and the price at which they buy or produce these goods is known as cost price. We always know that. Then the difference between the cost price and the selling price is the gross profit or gross loss. So profit and losses can be classified into two. So what we mean there is that we want to try to understand what is known as GP. GP. Gross profit. Gross profit is equal, the profit that we obtain is always equal to selling price minus cost price. Let's say that you used maybe 10,000 to purchase as an input in the business. You use 10,000, and after using 10,000 you managed to sell the total goods or products, or let's say stock, maybe to 18. So if 10,000 was the cost of good, then you managed to sell it maybe, let's say, 18. So you're going to say that 18,000 minus 10,000 is going to be 8,000. So in short, that is the cost. That's the gross profit. The gross profit. So that's in the determination of the profit. But there's a lot that we are still going to talk about. This is just trying to explain whatever we've read here. We are trying to explain it in arithmetical term. And the gross profit is all about the difference between the cost price and the selling price. And if the selling price is always, if the selling price is higher, then it becomes gross profit. If the selling price is less as compared to cost price, let's say that maybe here we are having 10,000 as selling price, then the cost price was 18,000. Then that means that the amount there will be negative 80,000. But you don't write negative, you omit the negative. So you write gross loss. So gross loss will be 8,000 if it was in an opposite. So when the cost price is higher than the selling price, then it becomes gross loss. And as I was saying, that business sometimes may make a loss instead of profit. So when it's a profit, that's what we obtain. So let's proceed. And we say that the profit or losses can be classified into two. One could be gross loss or gross profit, and another one, which is lastly net profit or net loss. But when you talk about net profit and net loss, that one we are going to talk about as we proceed. So let's look at the gross profit. And I think I've explained it, especially on the board. I've explained it, but still we can look at it. So it refers to the difference between the cost price and the selling price. So when the cost price exceeds the selling price, the difference is a loss. But when the selling price exceeds the cost price, then the difference is a profit. Exactly, that's what we have said. So the next thing, to determine the gross flows, a statement of account known as trading account is prepared. So we want to look at what's now that's the first accounting period. That is examinable. You will be always told to prepare trading account. So for us to determine gross profit or gross loss, the account that is used or the financial statement that is used to determine that or to calculate that is known as trading account. Trading account. So in determining profit, gross profit or gross loss, we use trading account. So we are going to start with the first one, which is trading account. Trading account. Trading account. So when you talk about trading account, there are some entries that ought to be there, and these entries starting with the stock that you have started with and the purchases that you've made. If let's say that you had a stock, like you are a business woman or a business lady or a businessman, and you want to do a business but you had some stock, what you do, you include that stock in the starting of a new business. Then that stock you add it maybe to any purchase. Maybe you felt like that stock was not enough, so you add purchase on that stock. Then if there are any returns, you subtract them. If you bought a stock, then you return them, you subtract it from the total stock. And without talking much, I want us to be looking some of the basic terms. When I say returns, we are going to talk about it literally, so it's good for me to go one by one. So to arrive in preparing trading account, one thing you ought to understand is known as return inwards. Return inwards. Return inwards. So return inwards, it is when you sold goods. Let's say that as a business lady or a businessman, you sold goods to the customer. Then the customer realized that maybe those goods were not okay, or some of them were not up to the standard. Then they managed to return them back to you or to the business. That is known as return inwards. They are always being subtracted from the total sale. In a layman's language, let's say you had 10,000. Understand? This is sale. Total sales. You see? But out of this total sales, there are some goods you sold to the customers, but they returned them. Let's say maybe return inwards was let's say 2,000. So if there was any sales return by the customers to the business, it will be subtracted from the total sale. And when you subtract it from the total sale, you'll have what is known as net sales. So when you are preparing trading account, wherever there is sales, you ensure that if there is a return, please, understanding this basic term is very important, because if you don't understand them, then you will be making a mistake in preparation of the trading account. So any return inwards are always being subtracted from the total sales. There is also another name that they can use to determine this. This one is also known as sales return. If they fail to say return inward, they may say sales return. So please, in preparation of the trading account, ensure that when there is sales return, you subtract it from the total sale, in any case if you are given that. So when you subtract it from the total sale, it will give you what is known as net sale. I think up to up to there we understand each other. Then the next basic term is known as return outwards. Return outwards. The second one is known as return and these are just basic terms in trading account. So this is number 2. Return outwards are also known as return on purchases. Return on purchases. Maybe you purchased goods, then after that you realize that there are some stocks that are not of good quality. You want to take them back. What you will do is that you will return those purchases. So that will be subtracted from the total purchase. Let's say you wanted to start a business and you started with a stock worth 30,000, right? So this is the purchase, or let's just use the word purchase. So purchase of the stock was 30,000. You want to start a business. Then later, after buying those stocks, you realize that these stocks, they are not in good standard, maybe quality, maybe let's say that there are something wrong with it or any other thing. So you decided to return some. So that return will be subtracted from the total purchase. So let's say that the return outward was, let's say, 10,000. So this 10,000 is subtracted from the total sale, and you have net purchases. So return outwards or return on purchases is always being subtracted from the total purchases to come up with what is known as net purchases. Then the next one is carriage inward. Yes, that's the third one. Third one, carriage inward. So carriage one is the costs incurred in transporting goods to the business from the supplier. So it's like the transportation cost when you are bringing goods from the supplier, a person that have sold the goods to you. So for example, you are from Nairobi and you bought a car, let's say maybe from Mombasa. So the transportation cost for that car to reach Nairobi is part of the purchase, and it's known as carriage inward. So it's always being added to the price of the purchase, or the price of that car. Let's say the car was 5 million and maybe you use maybe 50,000 to transport it, or you use maybe 10,000 or 20,000 to transport it to Nairobi. That 20,000 is being added to the total or original cost of that business. So it's known as, then they are also called carriage on sales. The other names is known as carriage on sale. So this is the cost incurred in transporting goods to the business from the suppliers. So they are also known as carriage on sale. Carriage on sale. So the carriage inwards are regarded as part of purchases, hence they are added. Just I've said it's always being added on the purchases. So when calculating the gross profit, we always add it in the purchases. So I want us to start, or to prepare a trading account, starting with the first example. So all of these we are doing so that we understand what a trading account is entailed. So if we did not talk about these basic terms, we will not understand how to prepare trading account. So let's look at that example there. So the following balances were extracted from the books of share traders on 30th June 2011. And shillings, you can see opening stock was 65,000. Then total sales there was 280,000. Then we were having purchases 190,000. Then purchases returns was 10,000. Then sales return was 4,200. Then there was something also known as closing stock, which was 70,000 as at 30th June 2010. So prepare the trading account for the period. Prepare the trading account for the period ended on 31st June 2010. So we are going to prepare a trading account. And how to prepare a trading account? We start with the title. In the title we write the name of the owner of the business there. So share traders. Then you say trading account, which is the statement. Trading account. Then for the year, before it's always being prepared when the business is being winded up or being liquidified. So not actually being closed, yes. Then for the year, ending of the year ended 30th June 2010. Okay, so this is the format. This is always the format. Then you write then CR. So here you start with the stock or the opening stock that you had. You can see we have been given opening stock. You see here the opening stock is 65,000. So we start with this opening stock. Shillings 65,000. That's where. Then after that, any addition in terms of purchases, you are there. You can see we have purchases there. So we'll say add. You don't write an additional sign, but you just write the word add purchases. So purchases, I want you to be writing something like this so that it becomes clear. So opening stock was 65,000 shillings. So purchases, we are going to add all of this. Then later, all the factors that may affect the purchases, we are going to add them, all of them in the middle. Then later, the final will bring it here and add it with the opening stock, the stock that was started the business with. So the purchase there was, the purchase you can see it was 280,000. Then we have purchases returned. Here they have written purchases returned. So that one we are going to less. Purchases returned, we less it, or we subtract it from the total purchases to have net purchases. So what you're going to do here is you write net. This less. You must indicate this. You cannot just write this one and expect us to know that you've subtracted or you've added. You must indicate with this one here. So you say less purchases return, or return on purchases, which is 10,000. So if you do that, you are going to have 10,000 minus, subtract it from 280, that is automatically that is 270,000. So this 270,000, we are not going to write it here, but we are going to bring it here, 270,000, so that we can add it with this one straight away. So 270,000 plus 65, it's going to be 335. Yes, 335,000. So this one is known as cost of goods. You see, opening stock plus adding the purchases, then subtracting the returns. So that means that what we have calculated is known as cost of goods available for sale. Meaning that when these people had acquired goods that they were ready to sell, if you add the total after subtracting what was returned, the total goods available for sale was 335,000 that was available in the business. But then this is not the end in this side. What we are going to do is that we are going to subtract the closing stock. We are told, if you go back to the entry, we are told that additional information there, closing stock was 10,000. So that's not 10,000 but 70,000, sorry. So that 70,000 we are going to subtract it from the total goods available for sale. Why? Because if you want to know the actual profit, we must subtract what stock remain, or the stock that remain. You cannot use all of this to claim the profit that you will bring unless you subtract what remain. What remain is not part of the goods sold. What you want is cost of goods sold. This is cost of goods available for sale. It was just available, but we are not told that all of them were sold to come up with the sales that we are going to see that we have been given in the information there. So what you're going to do is that we are going to also say less closing stock. And closing stock we have been given as 70,000. 70,000. So if you subtract 70,000 here, we are going to have I guess you should be having your book also, so that we are doing it together. 3 so 265,000. So this is the cost of goods sold. So this was the cost of goods sold. So out of this there was a sale. If you go back here, we are told that the sales, this is sales return. Sales was 208. Sales was 208. There is something, a little bit mistake that we have done there, but we are going to rectify it. So the sale, check here, sales was 280. The mistake is that we use the 280 which is supposed to be it's supposed to be 190. See, so 190, we're going to put 190,000. So if you subtract this one, it's going to be, sorry about that, we didn't check it well, so 180,000, we bring it here, 180,000. So 180,000, if you had with that one, it's going to be 245,000. If you subtract that, 40,000, subtract 7,000, it's going to be 245. Subtract 70,000. 175. 175. Sorry about that. So we are not seeing it. Let's begin now. So the sales was 280. We've written that, but we say that any sales return we are supposed to subtract it from the total sale to have a net sales. So we are going to say less sales return, or we say return on sales, still okay. Sales return. So sales return there was 4,200. 4,200. So if you subtract that one from there, we have 0, 0, 8, 5, 7, 2. Okay, so this is the net sales. My sale is 275, 800. So this is the cost of goods sold, this is the net sale. So we need the gross profit. The gross profit we are just going to subtract. We are going to subtract this cost of goods sold from the net sale, so that we are able to get a gross profit. So gross profit is going to be 275, 800, subtract 175. So we are going to say that GP balance carried down is going to be 100 100,800. So if we add this one plus this, we are going to have this one. So we're going to say 275, 800 is the balancing figure there. Then if you add this plus this, we also have 275, 800. But remember, this GP or this GP, which was a balance carried down, to make it balance with the highest figure here, it is being brought here as GP. So GP, this is like balance brought down, GP. So the business is having this amount here, which is 100, 800. In short, what we are saying is that in this trading account, after using all of this, the profit was 100,000 and 800. 100,008, 100,008. So we will say that GP, gross profit is equal to 1,800. That's the profit. So if in any case this place was higher than the selling price, the selling price or sales side, then that will be loss. So let's say that here was, let's say for example it is 275,000, here is maybe 300,000. That means that this business had a loss. But you don't write negative, you just write gross loss, and you get the difference. So this is the trading profit and loss account. This is how to prepare it. Otherwise, that's the end of our lesson today, and let's meet next time and proceed with the profit and loss account. Thank you, and have